The date is April 23rd, Wednesday. This is a Watchhimtrade.com webinar. First question I received was, do I ever look to fade a gap or use a quote-unquote fading the gap strategy? If so, what do I look for and what are my thoughts on it overall? The answer is yes. I definitely look at fading gaps as a legit strategy. You know, obviously anytime the stock gaps up, I'm thinking one of two things. Is it going to gap up and continue higher, or is it going to gap up and fade, which is what this question deals with. So the first thing I look for on any gap higher is the opening price action. Does the stock stay above or below its opening price? Next, what was the reaction, or what is the reaction at round levels? You know, numbers that end in 0 or 5s, as you'll see with this Google example in a moment, around 580 or 575. Those would be quote-unquote round levels. Then, if things are coming together, it's a matter of respecting reference point resistance, i.e. staying below the opening price, staying below that round level reference point, staying below the initial 3-minute low, 6-minute low, wherever you deem a worthwhile reference point to be. So if you come below the opening price right away or lose a round level, that's your first signal. And then if you respect reference point resistance, that is your confirmation to stay short on one of those fades. So let's look at some examples here. Some where fading the gap worked and you got some signals, others where signals never showed up and it wouldn't have been a good idea. So starting out looking at Google, and this is from April 4th, where you see my cursor now. On that day, Google opened at 580 after previously closing at 571. So a nice $8 to $9 gap higher. Now, the first thing I want to point out is Google opened right around 580. Okay? So right away, you have a round level test in the form of 580. That's what I would be thinking about pre-market. Then, as soon as it did open, look at the first move. Immediately lower from Google, okay? Crashed below its opening price. So off the bat right away, I see it rejected at the round level of 580. And number two, I see the flush beneath the opening price. So I'm thinking this is a short. I need to be shorting this, okay? Now it's a matter of getting confirmation. Well, what does it do next? It again continues lower below its initial 3-minute low here with this candle, the initial 6-minute candle, right? So then I'm getting confirmation. Now what? Now I need reference point resistance to get respected. So what are some reference point resistance points at this juncture once this is played out? Well, number one, round level, 575. That's simple enough. You lost 575, so now I need to stay below 575. Number two is the initial 3-minute low, initial 6-minute high, initial 6-minute low. You look, Google never made an attempt back above either of those resistance levels. In other words, it respected reference point resistance. What was the result? A very nice move lower here ahead of 10 o'clock, where Google fell from 570 to 558 or so. So just a very clean setup. This is the example of a clean fade on the gap. And just throughout the day, you know, Google never made any bounce. Look at where Google stalled out right here during 10 o'clock. Is that anywhere of significance? Well, sure enough, it's right around a round level of 565. Then look at where Google tried to hold around here. Sure enough, right around another round level of 560. And then another great downtrend overall through this. And I mean, once it's made this move from 570 down to 550, what more could you ask for? Okay. However, I'll still point out that on that bounce attempt, around 12 o'clock, 12:30, where did Google stall out? Around another round level reference point of 555. So clean signals showed up right away as you flushed below the open, and that fade played out throughout the entire course of the day. This would be the prototype of a fade the gap play. Doesn't always work like that though. So let's look at another example. April 8th. So Google on that day, April 8th, opened at 5:45 after previously closing at 5:40. So let's check out the intraday action there. Okay, so here you are, and I'll point out some differences and similarities. So once again, you opened on 5:45. So that's a round level. So we're watching, okay, does it go above the round level or does it stay below the round level? Google, in this case, opened above 5:45 and made a first move to the upside. So came above 5:45 and then came above, and with that, it was coming above the opening price. So right away, you don't have a short signal on this gap. You moved above the open, you got extension beyond the around 5:45 level. Then, okay, so it didn't give a first signal, but maybe it comes down and goes lower. What would we need to see in order to say, no, this will end up being a short, it's just going to take a little while? Well, we would need to see a support breakdown and then see that support turn into resistance and get respected. Well, that's exactly what you didn't see. Okay, you look at where Google pulled back ahead of 10 o'clock and then around 10:30, both of those levels were holding the initial 6-minute low on Google. So you actually had reference point support get respected, which is exactly what you can't see if the stock is giving a clean fade overall. So on this day, April 8th, gapped higher, just like the last example, but the price action was different right away. Never triggered a short signal like the other example. And that's a key difference if you just look and you see, all right, other day it moved below the opening price right away. On this day, moved above the opening price right away. Final example with Google that I will show is the very next day on April 9th. April 9th, you opened at 567 after previously closing at 557. So a very big gap higher, 10 points. I'll pull it up here on this chart. All right, now this is an interesting one because it's one of those sloppy fade the gap type plays that you have to look out for. That can be good, can be bad, can be kind of in between. So some similar characteristics. Number one, we opened, around 565. That's my round level reference point in this situation. Here's your opening price. First move right away is lower from Google. Okay, so off the bat, I'm thinking, all right, I'm short biased here on this move. Then our second move as well is lower. Okay, however, then we start bouncing a little bit with these candles from 9:39 to about 9:45. But remember, our first move was lower. We gave an initial short setup. So now we need reference point resistance to get respected. Reference point resistances are going to be the initial 3-minute low and the initial 6-minute high. You look at where Google stalled out around 9:45. It was right at that initial 6-minute high. So it did get respected, and then you had a nice move lower ahead of 10 o'clock, falling from 563s down to 558s for a solid 5-point move lower. However, notice this action on this day, unlike in the first example, Google was able to get back above this 560 reference point. Okay, so it couldn't really stay below 560 with consistency. So when you're coming back above that round level reference point, that's telling me this isn't a clean setup. As soon as it's getting back above it, really with this candle here, even though there was some further pressure, it's not the type of clean action that I would really look to participate in. Are there any questions about this example versus the first example, and why I would say that this isn't a clean fade the gap versus the first example, which to me was a very clean fade. Because these are the setups that will chop you up. You know, you think it's another fade the gap, which it maybe is for the first 10-15 minutes, but it doesn't show the same reference point resistance respect that the other day showed, and you have to acknowledge that. You know, you can't make an excuse for that. All right, so Google showed some good examples. Now let's look at Netflix for some examples here. Get a little flexibility. Okay, so starting out looking at just yesterday, April 22nd, earnings gap higher from Netflix. This will again be an example of not a clean fade, even though there were maybe some signals. But I want to point out what showed you right away that this wasn't going to be very clean. Okay, so number one, Netflix is opening on 377s. My round level reference point is right here, 375, or up here at 380, or down here at 370. You know, 372, 378, those aren't great round level reference points. Those are kind of random, unambiguous numbers to me. So, sorry, ambiguous numbers, not unambiguous. So here you are, you open 377s, and then look at this. Your first spike is actually to the upside. All right, so we see a spike to the upside off of a gap higher, and that tells me this isn't a short. Netflix is not a short right here because my first reference point is the opening price, and it's moving above the opening price. But then, where does it stall out? Right at 380. It respects that round level reference point precisely, okay, and then starts coming back down. So now I'm kind of thinking, well, wait a second, it moved above the opening price, but it did respect the round level of 380. Once I have those two thoughts, right away, just with this first 3 minutes of price action, I have to be aware that the price action wasn't clean. If it was clean, it shouldn't have gotten rejected above 380 if it was clean to the upside. If it was clean to the downside, it shouldn't have ever been able to make the push above its opening price. All right, so that's what's going through my head at this point. Then I see this move here lower. Okay, we take out the initial 3-minute low, we come back below that opening price, and so now I'm thinking, all right, maybe it is a short after all. And it does indeed trend a little bit lower. Notice, though, it gets down to 370, which is this line right here. Notice how it's able to bounce off of 370 and come back up. Yes, it then does get rejected back near the initial 6-minute high and the opening price area, but do you really want to have to worry about this type of move higher here where, you know, if you're short, if you get short on this candle, yeah, you catch, you know, 2 points worth of downside over 3 minutes, but then over the next 10 minutes, this thing rips back 6 points in your face and you're screwed. Now, what's the difference between the person who gets screwed and the person who's on their toes about that? The person who's on their toes about that identified within the first 3 minutes of the day that the action was very whippy off of that gap higher, that it wasn't really clean either way, as I discussed a few moments ago. So you can see that, yes, Netflix did come under some pressure, but it was slow pressure. It wasn't clean, it wasn't fast-paced, and it was just otherwise quite choppy. That, again, is not the type of action that I would want to participate in. Last example will be a later stage fade the gap setup. And let me find it here. That comes from Chipotle, CMG, on just last week, April 17th. The stock had earnings, opened at 582 from a previous close of 552. So let's dissect this one a little bit. So, number one, opening price. All right, here's my open. Okay, that's my first reference point. Number two, am I around a round level reference point? Well, I certainly am. I'm right on top of 580 here, so I can kind of observe, all right, what goes on relative to the open and relative to 580. Well, you see number one, it flushes beneath the opening price right off the bat. Number two, it loses 580. So right away I'm thinking, all right, this thing's a short based on the fact it came below the open and it lost its opening, and it lost the round level of 580. From there, what do I need to see? Reference point resistance get respected. Well, you look at this 6-minute candle, it gets rejected perfectly at 580. So my short setup has now been confirmed. And then over the course of that price action, I get a solid move lower from about 575 to 565 into the 10 o'clock hour. Now, here is where things start to get tricky on CMG. Number one, at this point, you know, if you're not locking in profits after catching a 10-point fade, then that's another discussion for another webinar. But nonetheless, things start to get tricky. Notice, though, what you could have spotted that said things are going to start getting tricky. Where are we once this price action right here starts happening? We're right around the round 570 level, okay? Just that round level. As soon as you regain 570, I've got to be thinking to myself, all right, didn't want to see it regain that round level. I'm staying out of here. Let's see what shapes up. What's interesting is then the action really slowed down for about an hour and a half to 2 hours. Even though it slowed down, though, notice that CMG continued to stay below its opening price area, and it continued to stay below the 580 mark overall. And then once you got into 12 o'clock, you came back down towards the low. And when did you know that the short setup was for sure back in play? Looky here, when you lost 570 again. Lose 570 again, got rejected on a bounce attempt to get back above it. Next move, right down to 560, another round level. So now 565, midway point, another round level. You look at where it got rejected, right on top of 565. Then you lose 560 again, boom, 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 boom. Right down, where does it fall to? Right around 540, okay? 545, midpoint right in between. You look at then where it started to get rejected on bounce attempts, right on top of 545. You lose 540 here. Where does it go next? Boom, 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 down to 520. Okay, and you know, if you weren't taking profits on a 10-point move, you've got a problem. And if you're not taking profits on a 20-point move, then you've got an even bigger problem. So, bottom line is the first setup that showed up was right at the beginning, and it was right as well later on in the day, meaning that it took some time, but ultimately Chipotle ended up flushing very hard and kind of respecting the first ability it showed you. The first displayed ability by Chipotle on this day was a fade on the gap. And while it didn't continue that ahead of 12 o'clock, once it lost these round levels again, and then once it lost low a day, it just really, the selling picked up hard. You saw a really good downside price reaction to losing those round levels. And those were the examples I had with fading the gap. Are there any other questions relative to that strategy? Okay, so moving on, next question. Next question has to do with the lingo that I use to describe my setups, and that is this over-under terminology. So I'll show you guys here. This person is a beginner and they want me to explain the terminology and where I get all my numbers from. So for instance, if you look at my prep work, you'll see the over-under 205 on Tesla was the setup on yesterday, where 210 is in play on the over and 200 on down is in play on the under. And then there's a bunch of numbers here after the over and a bunch of numbers here after the under. What do those numbers mean? Well, the terminology describes how I go about identifying a bias, either long or short. I choose a nearby round level reference point, just like we talked about with fading the gap. It's usually one that ends in a 5 or a 0, like 205 or 200 or 210 in regards to Tesla. And then I have an over-under setup where the over refers to the long setup, meaning that if the stock is over 205, then it is a long. And if the stock is under 205, then it is a short. This is a good simple way to guide your trades as you are making them. And each night I do this with my prep. I choose round level numbers based on where the stock is closest. For instance, Google is around 538, so my over-under setup is 540 because that is the nearest round level. If it was around 536, then my setup would be over-under 535. I then typically adjust my over-under as the market action plays out. If the stock is moving higher, say Tesla goes from 205 to 211, then I will adjust my over-under setup to 210. Or if Google goes from 538 to 533, then I'll adjust from 540 down to over-under 535, so on and so forth, where if you're down at 531, my over-under is 530. So just some examples based on current closes today. Amazon closed at 324.58, so my simple setup is over-under 325. Google closed at 537.50. So you kind of have a choice. You could either go with over-under 540 or over-under 535, or you could go with over-under 537.50. I prefer the level that I deem as most important, which to me would be 540, so I would go over-under 540. Priceline closed 1219.95, so my over-under setup is at 1220. Netflix closed. Oh, I'm way back here on Netflix. Where did Netflix close? Netflix closed around 354, so my over-under setup is 355. Other ways you can use the over-under is at a stock's opening price. Just over-under the opening price, just like we talked about with the fade the gap strategy. You want to see that over-under opening price action, as well as at a break-even price. Bottom line, over-under prices should never be random, unambiguous numbers. They should always have a meaning to you technically. All right, so what about these numbers that you see on either side of the over-under levels? For instance, in my example that she cited, I had 206.20, 207.25, 208.50 as resistance levels. And then on the under, I've got 203.90, 202.65, etc. So what about those numbers? Well, those numbers simply represent either resistance on the long side in the case of the over, or they represent support on the downside in the case of the under. How do I get those levels? I use a 3-minute chart to determine support and resistance levels, and I just kind of pick out levels that kind of stick out like a sore thumb to me. So sticking with Tesla, when I do my prep work tonight, I'll look at this action right here. That was the highest point during the 3 o'clock hour. I'll look at this price point right here, highest point between 11 and 12 o'clock. here is where it kind of gets subjective because, you could say this price here or this price here, which one do you choose? Well, for me, these two aren't as important as this price here from 10 o'clock. So I would not go with those, but again, it's subjective. Whatever you deem to be important support or resistance levels, that's what you should go with. All right, so right now, I've got 1, 2, 3 resistance levels, and then the fourth one I would take is the opening price action. So from today alone, I could just get 4 resistance levels. Now, what about support? Well, I need to do a little bit of work on the support side because Tesla closed right on the lows. So that means going back to what was, Tuesday? All right, so now I'm trying to pick out levels. I see really just the opening price right there from 930 would be my first support level. All right, now the other thing that's nice about doing this constantly is when you have a bunch of prep work that you keep track of, you can then just reference the old levels. For instance, today Tesla closed down in the 207s, kind of close to 205, in between 205 and 210. Since I prepared for Tesla just one day ago, now I can go back and I can say, okay, the stock's back here, so all of these support levels are back in play, and I don't have to go back and do the research because I already did the research and I didn't need it yesterday, but now I need it tomorrow, so I'll use it. If I was to go back, though, just to re-emphasize my point about picking supports and resistances, I'll show you where I would put some. Well, this afternoon low area, you seem to hold 204 really well. Held it all after 2 o'clock on Monday. And then you also had a low here, little pullback. Then off of that, you struggled with 200, but then when you broke above it right here, you made a really nice move. So 200 was resistance, so now I'd look for it to be new support. Got a level that sticks out here, another one that sticks out here, and then another one that sticks out here. The way to really get good at support and resistance is just kind of look at charts and write things down. Write support and resistance levels down, because then you'll be able to gain experience knowing when there's a level of significance versus a level that really isn't a major support or resistance level. I can just look at this and say, all right, boom, 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 that's where they are. I wasn't always able to do that, but I looked at a lot of charts over the years, and I still look at a lot of them today. So it comes easier. Next question. This person wants to know, what would I say is a realistic profit goal on a weekly basis with a starting account balance of $2,000? This person only has $2,000, but this is a very relevant question for a lot of people. And at one point, for myself, when you had less than $5,000, I mean, that's, it can be hard to get a lot of money together to trade with. So great question. And first, what I would say is before you can understand your profit goal, you have to understand your position goal, meaning how much money are you going to have in a position on a given day or in one given position. And at $2,000, I would recommend positions of $200 to $400 at a time. That way you have no more than 10 to 20% exposure on any one trade at any given time, and that will ensure when you have a loss, it isn't destroying your account. And as a new trader, you're going to have a loss. So with that said, I think it's realistic to also be getting anywhere from 20 to 40% gains on winning trades. That's just based on my own personal track record of winning trades. So that would put you at a profit target of $40/$80, between $80 and $160. 40/80 based on 20%, 10% of 200 to 400, 80/160 based on having 20% exposure of 200 to 400 when you're capturing 20 to 40% gains. So that's on winning trades. I think it's realistic to make one of those winning trades every day. So if you're executing well, which isn't necessarily easy, but I think it's realistic, you can have 5 winning trades per week. Based on my proposed examples, that would equate to gross profits of $200 to $800. Emphasis on gross profits. It's not net profits, because you have to assume there's going to be losers every week as well. But your goal should be keeping your losing trade half of your winning trade. So that way, if you're losing on those trades, instead of losing $40 to $80, now you're only losing $20 to $40. Or instead of losing $80 to $160, now you're only losing $40 to $80. That would then leave you with gross losses on the week of $100 to $400. And overall, that puts you at net profits of $100 to $400 per week. And I do think that is a realistic profit goal for someone who is starting out. Now, there will be major temptation to start out and make trades with all $2,000, or maybe, quote unquote, only $1,000. And if it works, your profit will obviously be much bigger. You'll probably feel good about yourself. However, if it doesn't work, which is probably more likely since you're a new trader, your loss will be that much bigger as well. Bottom line, I don't think it is good for your long-term goal, or what should be your long-term goal, of developing winning habits if you are trading with more than 20% of that starting $2,000 account at the beginning. Trust me when I say that the gratification you feel if you hit it right is severely outweighed by the stupidity you feel if you hit it wrong. I'll say that again. The gratification you will feel if you are right will be outweighed by the stupidity if you are wrong. So take that advice and do what you will with it. If you're willing to risk that stupid moment, then go ahead. But you want my advice, this is it. You need to understand realistic position amounts before you can try and develop realistic profit goals. And at $2,000, I personally would not be having more than $200 to $400 exposed at a time on any given trade. Just today, in fact, you can see that I have a closed profit loss of $109 on the day. You can see that down here on the lower right, well, just bottom of the screen. And if you were to look at my orders today, you'll see that my largest principal was $281. That was the most I ever had committed in principal. And I've got a $26,000 account. So even with that amount of money, I could have made all of these exact same trades with only $2,000. And I still would have made my $100. If you have a $2,000 account and you're making $100, I would think that's a really good capital return. But everybody's different. Next question dealt with my broker and why I switched from eTrade to TradeStation. Simply because eTrade was starting to suck big time. I was having constant platform issues. Level 2s would lag, orders wouldn't show up as filled in my portfolio when they actually were filled, and that was really the big one that really pushed me to switch. And then they'd have incorrect data showing up on option chains, and it just became too much. Making matters worse was eTrade never fixed the issues, and when I talked to them about what was going on, they didn't even know what the issues were. They admitted to me that they didn't really know how to fix it, and they would not guarantee that it wasn't going to keep happening. And it's a good thing they didn't guarantee that, because it started happening like once every other week, which was just completely inexcusable. So I chose TradeStation because they seemed like the most reputable retail broker out there. I assumed that if you had to have a minimum balance of $25,000, which you do to open an account at TradeStation, then they probably had their shit together, and so far that has indeed been the case. I've got two more questions dealing with my biggest gain and biggest loss, but I want to save those till the end. So I'm going to do the loan chart request that I had, and that was for Chipotle, CMG. Covered it during that Fade the Gap lesson, and we'll get a look at this daily chart now. So, number one, big drop off of earnings, and it started out as a positive reaction, but it turned into a negative reaction real quick. You've kind of filled what was this gap higher around 500, and Chipotle is just a pretty simple over-under 500 setup at this point. Okay, over under 500, where if you're holding 500, if you can get stability above 500, this could still represent a higher low versus that late January low, and you can trend back up towards 520 to 540. Ultimately, though, Chipotle will need to get back above the 550 to 560 range, as that was where it was going into its earnings report. Okay, so if you do get a bounce here, I would short Chipotle if you see it stalling out anywhere between this range, 520 and 540. That would represent a lower high to me and set up a test back down on 500. So that's the potential upside trade. Now, if you lose 500 here, key support is this late January low around 480. That would be my target on any holds below 500. If you lose 480, now things get much more interesting, because you would open up this wide gap between 460 and 440, which from 480, you're talking about additional downside of 4 to 8%, which is a really good dollar move on a stock as high priced as Chipotle. So observe what's going on at 500. That's the key right now. That's a good psychological level. If you can hold it, good chance of a bounce. If you lose it, good chance of a test of this 480 range. Okay, so final questions. They go hand in hand, asking about my biggest gain and what was that like emotionally, and asking about my biggest loss and what was that like emotionally. So starting with the biggest gain first, since that's the lesser valuable lesson of the two questions, there's really two answers here, because I used to trade penny stocks a lot, but then I shifted to options. So I've got my biggest gain in penny stocks, and I've got my biggest gain in options. My biggest dollar gain outright came from a penny stock. I made $25,000, and to me it was just pretty much completely dumb luck. I was maybe in my 6th or 7th month of trading penny stocks. I was a freshman at DePaul University here in Chicago. I put in about $4,000 to this stock that I don't know, came across on iHub or something, and just got completely lucky. It got pumped, and I didn't know what was going on, but I was greedy enough to hold it for a 500% gain, but not stupid enough to not sell it at a 500% gain. So I ended up pulling out $30,000. And that was definitely a really big emotional high because, at the time I felt like, oh, I know what I'm doing, and definitely felt like I was on cloud nine. And I remember specifically telling a lot of my friends about it and kind of bragging in a way because I remember a lot of them, and this was my perception, they never said this, I felt that a lot of them thought I was stupid for getting into penny stocks and just getting into the stock market in general. We had all just started out at school, and I kind of felt like the perception is, why are you doing this? You need to be focusing on your studies, and we're all going to get good grades and graduate and get good jobs, and you're going to be trying to figure out stocks. So I definitely kind of rubbed it in some people's faces, and looking back, I felt like a pretty big dumbass about that, a dick, so to say, and realized that it really didn't do me any good to share that success with them, because I sure as hell wasn't going to tell them about all the struggles I had had up to that point. I wasn't going to tell them that I started with $7,000 and I lost it all and had to put in $4,000 to restart my account. So why am I going to tell them about, the success? So that's the penny stock story. So then, 2 years later, I was bigger into options at that point, and my biggest gain in options came from Apple, and I made $17,000 on a day trade, and that was on this day here. Apple had lost 520, and just this was a great clean breakdown below 520, and it flushed out, and I caught a big move lower, and I definitely felt like after that gain that I had arrived as a option trader, that was the validation I was seeking in confirming that I know what I'm doing. And I think I also kind of got complacent because while I was motivated to make more money, I felt like after that, all right, now it's just going to start to come and trickle in, and I don't really need to improve because this is what I'm capable of, so this is just what's going to happen to me all the time. Now, later that evening, I looked back because that day after I made my 17K, I just kind of called it a day. And then I came back, and I remember I shorted Apple from like 420 to 413. Well, you look at the thing, it ended up going to 400 bucks. My position that I had, if I would have executed better, could have easily been a $100,000 to $200,000 trade profit-wise. So as far as how I dealt with it, I don't think I dealt with it well because I didn't have good perspective. As I stated, I kind of felt like I arrived. And this is a good lead into, my biggest loss because it came 2 days after my biggest gain on this day here. Literally 2 days later. So April 17th, 2013, is that what this is? Yeah, it's got to be. So then 2 days later, April 19th, on this day that I just circled, that was my biggest loss ever. It ended up being much bigger than my biggest gain ever. The total amount was a $42,000 loss in one trade, which was about 85% of my portfolio at the time I was trading. And, I didn't deal with that very well at all. I would honestly say it was extremely depressing and life-changing, really, and it consumed me for a long time. I don't think I got over it. This was April 2013. I honestly don't think I got over it until September or October of last year. So, what? May, June, July, August. I mean, about 4 to 6 months. That loss was legit on my mind every day, all day, and was really a motivating factor for a lot of the things I was doing, which you could guess probably wasn't a good motivating factor for everything I was doing. And basically what happened, before I go into, how I feel like I dealt with it, what happened is, this day right here when I made the 17K on a great trade, well, I tried to make the exact same trade on April 19th. The problem was the price was different. You can see Apple had lost 420. That day it was around 390, so you're talking about a $30 drop already. Secondly, the price action was different. You could see volumes lower. The range was tighter. Okay, it wasn't breaking below the previous day's low like it was on that day I made the big gain. So just overall, the setup was different, and as you might have been able to guess before I even told you what happened, the result was very different as well. So that's the execution side of what I did wrong. I tried to make a trade that wasn't there. So the other thing that's interesting is I was actually live trading at the time, and how I dealt with it immediately is I really just kind of shut down. I felt extremely embarrassed and reckless. I turned off the live trading system without saying anything to anyone. I just made a message in chat that kind of said, fuck, blew up my account. Really sorry, guys. I'll see you Monday. And, after I signed off, I just remember kind of losing control and just yelling, being extremely upset with myself and, wanting to punch a hole through the wall. Why the fuck would I do something like that? I remember looking in the mirror and saying to myself, are you happy now? Are you happy with what you did? Because I was just so down on myself. And, what hurt the most is that after that, I was forced to just question my discipline. After doing this for a few years, how could I have a setup like that go so terribly wrong? How could I lose so much money? How could I be so irresponsible? The only way is because I wasn't disciplined. And that was hard to admit. And like I said, I think I didn't really admit that to myself until a few months later. So then, I remember calling my girlfriend and asking her to leave work to, I just wanted somebody, and, called her, and she came up, and I remember just sitting on my couch looking out my window, and I was trying to cry. I was trying to force myself to cry so that I could really show her how painful that morning was, and, get her to really grasp what was going on, because I didn't think she really understood it. But, she just kind of told me that it was okay, and every good trader probably loses a lot of money, and I kind of brushed her off. But, she's probably right. And she was a big support system for me on that day. And, that told me a lot about her and helped me learn a lot about myself. And, now we're going on 2 years together, in case you care about that. But so she calmed me down, and then I went and shot around at the gym, because basketball has always been an outlet for me really my entire life. Started playing at a young age, and if I'm frustrated or anything, I can always find solace on the basketball court. So that's how I dealt with it in the immediate term. And then that weekend, I watched the film of my big loss and, kind of laughed at myself, because it was so clear on the film how bad of a trade I was making when I was watching. But that's the way it always is, right? When you think about it in hindsight and you see it, of course it looks stupid. But, the reason I say that I dealt with the loss for months is because as bad as I wanted to, I couldn't shake how embarrassed I was and disappointed in myself really all summer. Because remember, I had this service. I had just launched Watch Him Trade in March, and this shit happened in April. Subscribers were on the up and up, and as you might expect, I lost a lot of subscribers after that, and it was just hard to deal with. That I felt like my business was struggling as a result of that, and I felt that the only way to fix things was to just make perfect trades time and time again, because I knew or at least I thought I knew what people thought about me, and I had to change what they think about me. I had to recoup all of my losses and show them that I'm the best, and that's what I wanted. But then, finally in the fall, I just kind of had this revelation that, you know what, I care way too much about people's perception of me. I always wanted so bad to be the best trader, and what I wanted even more was that for everyone else to think I'm the best trader. And that psychological makeup was really actually restricting me from becoming the best trader I could be. It was counterproductive. So in the fall, around September, October, I just kind of said to myself, you know what? You're not allowed to trade with more than one contract at a time until you prove to yourself that you're disciplined as fuck. And that's really what it comes down to. And I started to trade much better from that point on. I stopped being so analytical with my analysis and just started focusing more on price action. I stopped trying to impress anyone but myself. I stopped caring when people unsubscribed. I stopped caring when somebody did subscribe. And I just started being happy about everything I was putting into trading. I just got my energy level back up and just kind of decided, you know what, I'm going to be happy if I make $50 profit if it means I made 50% on my trade, and I'm going to be pissed off if I only lose $50 if it meant I lost 25%. I just started caring a lot more about the details, not as much about the money. I raised my standards of what being a great trader is and stopped worrying about my reputation and just started worrying about how I and only I felt about the work I was putting in. I could go on and on about this and how it affected me and how I dealt with it. I'll probably dedicate a couple chapters of a book to it later on in my life, but what you need to know at the end of the day is that the big loss sucked, and by not acknowledging the real problem right away, which was my constant desire to impress everyone, the loss consumed me for months, and it wasn't until I lost that desire and focused on my own growth for myself that I started to get over it and really be at peace with myself and start to improve as a trader. And that is a wrap on all the questions I received. So are there any questions about anything that was discussed here? Questions going once. Going twice. All right, guys, thank you for attending. This was recorded, so it will be posted to the site and emailed out to you for your review. And I will see you tomorrow morning. We'll have another one of these next week, scheduled to be determined this weekend. Thank you for attending, and I'll see you tomorrow morning.